Hi, I'm Guillermo Narvaez, Technical Tax Director of the Global Tax Group of Kreston Global, and this is the 2022 May edition of the InTax News. In this edition, we have news concerning international tax matters, like when a headquarters is entitled to the residual benefit of the operation of affiliates, another decision on how to apply an anti-abuse rule, are written contracts enough to prove a provision of service, and when a most favored nation clause can be applied. Welcome to the program. The news to discuss in this edition is divided into two videos. In the first one, Sweden. The Pandox case determines the amount of profits generated by an affiliate that should be recognized by the headquarters. Trinidad. A tribunal in Trinidad ruled when a domestic GAR or anti-abuse rule can be applied over a provision of a double tax agreement. And in the second video, the news is Spain. Frequently, it's hard to prove that a service has been provided, but evidence must be shown to avoid a potential tax liability. The question is how relevant can be a written agreement to demonstrate that service has been provided. India. The tax authority in India stated its official standpoint on how an MFN or most favored nation clause included in a double tax treaty can apply. Welcome to the 2022 May edition of the InTax News program. I trust you enjoy it. In the Pandox AB case, the Administrative Court of Sweden ruled in favor of the taxpayer against an assessment of the local tax agency where the ratio of benefits between related parties was pretended to recalculate. Pandox AB is a management property business established in Sweden, focused on the hotel industry with operations abroad. The affiliates of Pandox are dedicated to provide different services to their properties, and their income is obtained from leasing the properties to hotel operators with a return on the revenue of the operators. The headquarters of Pandox provide support to its affiliates in activities like back office, treasury and financing, and management. Those intercompany operations were remunerated at arm's length. The Swedish tax agency claimed that given the role and activities performed by the headquarters, the Swedish taxpayer was entitled to residual benefit of the management performed abroad, given the nature and relevance of its activities, and the affiliates should get only a risk-free return based on government bonds at 10 years. Pandox proved that all operations with the affiliates were priced according to transfer pricing rules, and the subsidiaries should get more than a risk-free return, given that they really carried out the management of the properties and the headquarters just supported the operation of the subsidiary in a very specific tasks that were paid in accordance with the market. In short, the arguments of Pandox were based on demonstrating that the affiliates did really perform the necessary functions to carry out the management of the properties, assuming the risks of the operations, and not the headquarters, that although it had the power to control the management abroad, it didn't assume it. The court agreed with the arguments of Pandox, including that the headquarters intervened in searching for new acquisitions, but after doing the respective analysis, it didn't take control of the operations of the new properties. The court also recognized that the affiliates had sufficient capacity to carry out all functions, and such functions were performed during the management of the properties. Therefore, the assessment of the tax agency was rejected. Finally, one point that really caught my attention was that in the ruling, the court affirmed that a business without employees may be entitled, under certain circumstances, to the residual benefit of an operation, although the lack of workforce. Given that this ruling was set out by an administrative court, we'll likely see a new ruling from an upper court. Once again, we find a case of a domestic anti-abuse rule, GAR, against a provision of a double tax agreement, or DTA, When the DTA permits to transfer dividends without a tax liability, but a domestic GAR dictates otherwise. Canadian parent company has set up legal entities in Cayman and Barbados, and the latter owns an operating company in Trinidad. The Trinidad company paid a dividend of $84.5 million to its shareholder, an entity established in Barbados. After receiving the dividend, Barbados distributed a dividend to its direct parent company in Cayman in the same amount as the dividend paid by Trinidad. Finally, Cayman did exactly the same as the other two affiliates, distributing the dividend to the final parent company of the group in Canada. This is a plain scheme easy to understand, but with sensitive implications on international taxation, and it has been repeated hundreds of times. A parent company that indirectly owns a business in a third country decided to get resources from an associate company in a third state. However, in order to fulfill with its decision, it's necessary to transfer the funds as a dividend payment from the source company to one or more intermediate entities in order to comply with corporate rules, given that the final parent company cannot receive the dividend straight from the source entity, despite that the parent indirectly owns 100% of the equity of the source company. The funny thing is that these schemes have some common features that are repeated in no casual manner. What we continuously see is a chain of companies between the parent and the source, which have the benefit of no withholding tax on dividends, whether for applying a DTA, a regional tax treaty, or a domestic benefit granted by a local statute. Another relevant feature in these schemes is the impossibility of the parent company to get dividends without paying tax for the distribution of dividends if the parent would directly own the source company. Therefore, the company or companies between the parent and the one that distributes the dividend broadly act as conduit entities or pass-through companies, with no decision or interest in receiving the dividend from downwards, but only to comply with instructions from the parent company. This was the context in which a court in Trinidad finally ruled that a withholding tax of 5% on the amount of the dividend should be paid according to the Canada-Trinidad DTA, due to the whole scheme was used with the only or main purpose to obtain a tax benefit from a double tax treaty in an operation with lack of substance and business aim. The big takeaway in this case is that GARs or anti-abuse rules appear to remain in the international context, and when they are in conflict with treaty provisions, broadly, the GAR is preeminent. Hence, our advice to our clients could skip an issue with the tax agency.